I'm going to try something that, frankly, I've avoided over the years. Most of the videos that I create are what you would call evergreen. They're topics that if you saw the video this year or 5 years from now or 10 years from now, I try to stick with principles that just don't change. But I decided I might start occasionally doing one of these. I'm going to call it Financial Advisor News Block. So, what is it? I'm going to talk about things that are in the headlines that are timely. What made me decide to break my policy and do these, which will be time dated for the future, is two reasons. One is I always tend to deal with big concepts. So in the future, I will keep this video live, whether I'm right or whether I'm wrong. It'll put a point in time that I was making a call, and we can look back and say he was right or he was wrong, or did we learn something from the exercise? But the other thing is, we are in a position as financial advisors to help our clients through times like this. Right now, in the headlines, we have all this, it's described in the media as chaos out of Washington, having to do with trade policy, tariffs, all manners of economic things having to do with the bond market. It gets very complex very quickly. But I'm going to spend a financial advisor news block trying to give you my perspective on headline issues in a way that you can focus your clients on the only things that matter. And that is the fundamental principles of your investment policy. Now, my fundamental investment principles were trained to me back in the 1980s when I got into this business by some legends in the financial services industry back in those days. They're still around, like Nick Murray and Don Connolly, and I could name a dozen either money managers of that era, external wholesalers that I got to know over the years who were really good at helping take the current environment and package it up and explain it to clients in a way that would help them understand it, but only understand it to the point that they understand that they can stay on track to the three fundamental investment principles that matter. So I'm going to share my fundamental investment principles. My call to action to you is to see how well aligned your fundamental investment principles are to your clients and see if you can create a formula for taking the headlines and putting it in perspective only if you feel this way. So I'm going to give you my perspective. You may agree or disagree, but the point of the exercise is to be able to take the headlines, and if you have confidence that you believe that the fundamental investment principles are still at play, then you can use all of that explanation with a client to get them focused on really the only thing that matters to them. The three fundamental investment principles that I've utilized for 30 years is to work with me. I explain to clients, and this is in the very first meeting, and I say for us to work together, you have to sign on to my fundamental investment principles. If you can't sign on to these three things, then I don't see how we can work together, because this forms the foundation of everything. It's faith in the future, patience is required, and discipline avoids mistakes. That's it. So you can see if clients are on board with that. But now you come to an environment like this. Let's say I've had a client for a decade. Now they're all concerned and wound up because of all these policies in Washington. And the only reason clients ever care about pretty much anything is that it's affecting their accounts. So they're seeing equity markets going down in value. How do you make sense of any of this? I'm going to put it into context so that at the end of the logic, as you figure out ways to explain this to clients, just to react to their questions. I never force any of this onto clients. I just wait until they ask me. When a client hits me with, what's the strategy now that chaos is coming out of Washington and the stock and the bond market both are having toxic reactions, obviously my accounts are going down. What's the plan? Okay, so that's the scenario. You have a client calling in. So you're not forcing any of this there. You're just reacting to them. To which I would respond, on the surface, it looks like something's happening. The things that I've noticed in the last 100 days since we had a new presidential administration come in, the market has reacted in a noticeable way, up or down, in reaction to policies and statements by the new administration. And I would say, in response to this situation right now, that as we look at the last few times the markets reacted, it's been a short-term reaction that's really not connected to anything. And if I were to sum up the last reactions over the last 100 days where the markets move up or down, it's really, when it's moving down, I've noticed that it's actually the administration following through on something that they have been saying for 6 months or a year, even before the election, but nobody actually believed he'd do it. So here they are doing it, and the markets didn't mark it into the market because they didn't believe he would do it. But in effect, he's actually doing what he said he would do. For this right here, this issue with tariffs and trade and bonds and all of that, I'm going to go back to before the election. At the time, our current Secretary of the Treasury was just advising the campaign, and he did an interview before the election. They asked him why he's involved in this, because he's been somewhat apolitical over the years. He's former hedge fund manager, lots of applied experience in the macroeconomic area. He's famous for some big transactions, putting his own skin in the game, him and his firm, and making bets on some macroeconomic conditions that he saw unfolding, which ended up paying off big. But the point of the fact is, he is a Secretary of the Treasury who's been in the trenches, put his own money on the line, and been wrong sometimes, right sometimes, but he's famous for being right more than he's wrong, and made a lot of money doing it. So before the election, I noticed in an interview, he said the reason he was involved in this election is because he saw the buildup of some previous historical trends that have been negative to our economy, that he sees a global realignment is possible, and he'd like to be a part of it. And he called it Bretton Woods 2.0. All right, so let's back up. What's Bretton Woods 1.0? Bretton Woods 1.0 was at a time in our history, right after World War II, where on 3 continents after a world war, cities were devastated from bombing and just the devastation caused by war. Germany, of course, was leveled, and Europe, Japan, we had places around the globe that were in disrepair, let's call it. And so Bretton Woods 1.0 was where all these countries after the war came together and agreed, let's make the US dollar the global currency. We'll peg all of it, everything to the US dollar. It'll be the sovereign global reserve currency. And what does that mean? It was the US saying, you guys need help. You need to build up your economies and rebuild your cities. We'll take it on the chin. We'll suffer the consequences of something that will be long-term negative for us, but it needs to be done right now. So we agreed to be the global currency, which means we agree to buy the world's goods, and that means we get the globe's production, their services and products. We will consume it. And what do you get in return? You'll get dollars. So we'll pay you dollars for all your stuff, and we will take your stuff, and there will be a trade deficit as a result. So now we're sitting here with a trade deficit. They're sitting there with tons of dollars now. So the question is, what do they do with the dollars? Predictably, what they end up doing is they don't invest that money that they've earned from our consumption in their own economies. No, they invest those dollars back in the U.S. in companies and U.S. government bonds. In other words, they spend the money that they earned in U.S. dollars back in U.S. dollars so that their currency weakens up against ours, so that their stuff, their goods, are cheap looking to us. So it's been decades and decades, let's call it 70 years, manipulated currency where their currencies are purposefully weakened so that our purchase of their goods looks cheap. So these trade deficits have built up to the point where even at the time, Bretton Woods 1.0, if you read the newspaper articles and the government announcements, it was supposed to be temporary. So we have a temporary policy that here we are, flash forward in the year 2025, we're still living it. We have a Secretary of the Treasury who is trying to realign the global order. He's trying to get these countries to reinvest some of our consumption and giving of them of U.S. dollars into their own economies, which will harden their currency against ours. And that leaves us with less trade deficits and less capital surpluses. So we don't have as much of their money coming into our stock markets, which is distorting the S&P 500. And in 2008, we had a global financial crisis. And here we are as a global reserve currency, but we, in case of emergency, we take our interest rates to zero. Interest rates are nothing more than the price on our money. So back in 2008, and again during the pandemic, our Federal Reserve and our Treasury coordinated to decide to tell the world that our money is worthless. It's free. It's close to zero interest rate to borrow it if you're another country or if you're a major institution. So we need liquidity. We'll just make the dollars free. That literally broke the bond market. So now you have an administration coming in who's trying to readjust the global realignment of global trade, and they're using tariffs, and they're playing their strategy close to the vest, which is being described in the media as chaos. But it's only been a week or so of these headlines. I predict that long term, give them a chance. You have a Secretary of the Treasury for the first time in my memory that has applied experience where they've been active in the global macroeconomic environment with their own money, making decisions. Every Secretary of the Treasury prior to this has been either a corporate stiff like a Goldman Sachs executive or an academician like an economist from Harvard or something. Now we have somebody with applied knowledge who's trying some things. And what we are now reading in the media as being flip-flops on their strategy from just a week ago, maybe it could be also fairly described as thinking things would go one way, they notice the market's reacting a different way, and they make a tactical decision on the ground to shift strategies, which did calm down the markets for the next 90 days, which gives them a chance to keep making decisions moving in the right direction, trying to fix our trade imbalances. This has been a capital surplus from these other countries over the last 7 decades. What it has ended up doing is distorting our equity markets. So they're playing with fire and they know that. But to me, they've shown that they are willing to make course corrections. They're not stubborn. They are humble about their own policies in that they will change on a dime if they think it will stabilize and help the markets operate more orderly and keep the markets more stable in the long run. So I would tell Mr. and Mrs. Client, that's another point of view. I am looking at the long run, but I feel like I'm being, from a macroeconomic standpoint, very fair. If I felt like there were mistakes being made that would negatively affect your long-term portfolio, I would just tell you. So the policy of this firm, meaning me managing your money, is stay the course. You have every reason to believe that you can have faith in the future. Everything will ultimately be okay, even though right now, right here as we're sitting, we don't know how, but it will. You can continue to have faith in the future, if only because we've had situations like this or worse, like World War II, where we made it through that just fine. Faith in the future, still in play. Patience is required. As I told you the first day we worked together, you have to be patient with these long-term investments that we have deployed in your situation. These require time to unfold. Now, that said, if I saw something happening in the short-term macroeconomic environment where things have so substantially changed that patience as a strategy will no longer pay off, I would tell you. But that's not the case. I point to one thing in the headlines that doesn't just scream that we need to be patient and see how this plays out, if only for the reason that the markets did stabilize over the last week. And then third, discipline avoids mistakes. The worst thing any investor can do in an environment like this is make a decision on emotion that is not tied to anything. Let's say you're so worried you can't sleep at night, so we've got to do something so that we no longer have faith in the future. We no longer have patience to manage a situation that, yes, it's a realignment of global order, but we've been through worse and things were fine. Patience seems to be still the ingredient to the cake that we're baking here. And then discipline avoids mistakes. The secret weapon in your portfolio is there is a strategy and you're going to be disciplined, and that will be the payoff in the long run. So I just wanted you to listen to this and not necessarily to agree or disagree, but just to ask yourself this question. Do I have fundamental investment principles? Have I conveyed these principles crystal clear as I just did in this video? If not, when are you going to fix that? Number three, arm you with, assuming you've had this conversation with clients and something happens after that, have you earned the right to go back when things start looking like they're falling apart in the markets and remind the client of this conversation that you had long ago, where you went through the fundamental investment principles and they signed off on those three things at the time? Now you've earned the right to sit down with them and hold them accountable to those three principles. That's the message here. I'm going to do financial advisor news blocks for two reasons. Put myself on record on things that are in the news. If nothing else, it'll be hilarious to look at a year from now, see how far off I was. But I think the main reason of doing these blocks is to show you how I would recommend that you handle client emotions during periods of turmoil, good times, bad times, and we'll just deal with them periodically as I encounter headlines that I think clients are going to be reacting to, because my own clients are still reacting to these things. We'll just together work it out. How do you talk these things through with clients so they can maintain faith in the future? They can maintain their patience, which is required, and they understand and remind themselves that discipline avoids mistakes. See you in the next video.